The housing markets in the United States and several other countries are facing an imminent collapse, potentially surpassing the magnitude of the 2008 housing market crash, which was considered a once-in-a-lifetime event. The Federal Reserve, Fed, in an attempt to combat high inflation, has aggressively raised interest rates, leading to a doubling of rates on 30-year mortgages. Consequently, the cost of borrowing and obtaining mortgages has significantly increased, resulting in a decline in sales of existing homes by nearly 25%. The confluence of high inflation, rising interest rates, and the collapse of several U.S. banks has had a detrimental effect on economic growth and has raised concerns among investors. The housing market boom and overvaluation. The housing market experienced a significant boom in recent years. In 2020, as COVID-19 brought the world to a standstill, interest rates were lowered, making debt and mortgages more affordable than ever before. Simultaneously, government stimulus packages provided relief funds to many American families, leading to increased purchasing power. Americans seized the opportunity to buy larger homes through higher-priced 30-year mortgages, either as an investment for the future or to accommodate the shift towards remote work. This surge in demand drove property values up across the United States. For instance, average property prices in Houston, Texas, rose from around $250,000 in 2020 to almost $350,000 in 2022. Similarly, prices in Boise, Idaho, increased from $350,000 to nearly $600,000 within the same time frame. In 2020 alone, the U.S. housing market soared to $36 trillion, gaining nearly $2.5 trillion in combined home value, marking the highest annual increase since 2005. The year before the mortgage-backed securities and centralized debt obligation bubble was exposed by Michael Burry. Current warning signs and concerns. The beginning of a housing market correction is evident, with mortgage demand falling by 13.2% in the last month of 2022, according to Canfor reports. In addition, average Americans are experiencing negative real wage growth of 2.6% per year. S&P Global Ratings predict that the leveraged loan default rate may rise to 2.5% by the end of the year, highlighting challenging credit conditions. These factors, combined with the increasing burden of mortgage costs and the diminishing ability of individuals to afford their living expenses, are leading to a rapid rise in defaults. The role of Dave Burt, a warning from history. Dave Burt, CEO of investment research firm Delta Terra Capital, was one of the few skeptics who accurately predicted the collapse of the real estate sector in 2007. Depicted in the best-selling book The Big Short, Burt played a significant role in foreseeing the impending financial crisis and profiting from it. He now believes that there is an overlooked factor that could crash the housing market in the near future. Burt's credibility, coupled with the insights from The Big Short, has attracted attention from other investors who share his concerns. Hidden risks, flooding, and climate change. Burt's warning revolves around the mispricing of flood risks and the lack of insurance coverage in the mortgage market. Climate change, accompanied by rising sea levels, poses a significant threat to coastal areas. Approximately 14.6 million homes in the U.S., or 10% of all properties, face substantial flooding risks, with the number expected to increase by 1.6 million homes by 2050. Cities like New York, Miami, and San Francisco, collectively valued at over $5 trillion in real estate, lie precariously close to sea levels. Recent devastating floods in countries like Pakistan and Nigeria demonstrate the potential scale of destruction if such events were to occur in developed nations. Implications of the housing market collapse. A housing market correction triggered by flooding risks could result in a loss of $800 billion in home value across the U.S., according to Burt's calculations. Only 4% of homeowners nationwide currently have flood insurance, leaving many families vulnerable to losing their largest asset and leading to a decline in consumer spending and economic growth. The consequences would extend beyond homeowners to include major financial institutions, such as Bank of America, Wells Fargo, and JP Morgan, who hold substantial mortgage-backed securities portfolios. Even the US government, with a reliance on these securities, could face its first official default. Global ramifications. Flood risks and mispriced properties are not limited to the US, but extend globally. In the UK, flooding damages already amount to £817 million per year, significantly impacting GIB. The most densely populated cities in the UK face a projected increase of over 25% in property damages caused by flooding. In England, approximately 6 million homes, or 1 in 6, are. These examples highlight the global nature of the problem. As climate change continues to exacerbate flooding risks, the implications for the housing market and economies worldwide become more pronounced. The interconnectedness of the global financial system means that a housing market collapse in one country can have ripple effects across borders, potentially triggering a wider economic crisis. Mitigating the risks and finding solutions will require coordinated efforts from governments, financial institutions, and the insurance industry. Improved risk assessment models and accurate pricing of flood risks are crucial to ensure that property values align with the potential dangers.